Hi, and welcome to the week ahead. I'm Tony Nash, and today we're joined by Blake Morrow, Tracy Shuchart, and Albert Marko. So thanks, guys, for joining us. Today we've got a few key themes. The first is the dollar, and we're going to talk about the dollar in relation to the euro, Japanese yen, CNY. We're also talking about commodity resurgence and earnings. So before we get started, I'd like to let you know about a promotion we're doing for CI Markets, our forecasting platform for stocks, ETFs, indices, commodities, currencies, Forex, and economics. For the next 2 weeks, we'll buy the first month of CI Markets for you. Go to the link to find out more. At checkout, use the code 25OFF. That's the number 2, the number 5, and the letters OFF. This will give you the first month free when you subscribe to our $20 or $25 a month plans. Get fresh market forecasts every week, accountable forecasts where CI discloses our error rates, and a growing set of capabilities. We've just launched the top 50 US ETFs, NASDAQ 100, Nikkei 100, FTSE 100, and so on. Check out CI Markets today and use the promo code 25OFF. Thank you. So guys, thanks so much for being here. I really appreciate the time as always. Blake, it's your first time here. Thank you so much. I appreciate, I've heard great things about you and I follow you on Twitter. I want to start by talking about the dollar. We just had another 25 basis point move by the Fed and the ECB this week. And after a couple months of hearing about the dollar's demise, which Albert and Tracy and I have kind of laugh at every time we hear it, you yesterday on Wednesday were looking for strength to return to the dollar, and we saw that Thursday this morning after the ECB meeting. Can you walk us through your case for dollar strength?
Yeah, sure thing. And by the way, thanks for having me here. It's first time, and hopefully not the last time. It's really an honor to be here with you guys. This week was kind of a unique week because we had the Fed, ECB, and the BOJ is happening tonight, and we just had some headlines come out less than an hour ago that's really moving the markets. But it's rare when you can get these central banks, you have a good understanding from a macro point of view, fundamental point of view, what to expect. And in this case, we had the Fed that, I think we're all coming to the realization that the Fed, even though they've said this many times for months and months and months, rates are going to stay high for probably a long period of time. And something they said yesterday that really caught my eye, or caught my ear rather, was that their internal economists aren't even forecasting a recession, which means that if you were thinking when we get in a recession, the Fed's going to eventually cut rates, they're not going to. So that automatically, I was assuming that they would message that they were going to keep rates higher for longer and try to drill that in. I didn't think it would come out in that way. However, I also figured the ECB, which came out this morning, and if you saw Christine Lagarde, I almost thought her shoulders were really slumped over. She looked really not so optimistic, and she was very dovish, more so than I've ever seen her over the last 12 months. I figured that was going to be the case because the European data has been really deteriorating. And so, I figured that she would be somewhat dovish and maybe not lead us down the path that we're going to get another rate hike, which I think that was the case today. So it just so happened that it worked out the way that I anticipated. But let me be the first to say, Tony, that doesn't always happen. By no stretch of the means, it did really work out according to the way I planned it this week. So
take the win, right?
Hey, I'll take it
the win,
time.
Right? So
I take plenty of losses, so I'll take the win.
So with Powell yesterday, one of the things that I noted that he said policy is not restrictive enough for long enough to have its full intended effects. And so that the higher for longer is just all baked into that sentence, right? And shortly after that, he said, we have a long way to go. And so I think there were some people who walked away from that press conference thinking it was dovish, and I just didn't hear that at all. Did you hear dovish comments out of the press conference?
No, I think it was pretty well balanced. But the higher for longer, I think it's starting to resonate with the markets. But between that and between, you know, the ECB and now the BOJ, I think the markets are starting to understand, and really you're taking the Bank of Japan, which is the last G10 central bank that has ultra loose policy, that might actually get removed or start the other direction as of tonight or tomorrow morning in Asia. And I think the markets might be getting the hint now. And I think we're starting to see signs of it. Actually, today would be the first day in that we are.
Right. And then ECB made comments about end of cycle, right? So she really wants to be at the end of her rate rise cycle, right?
She does, and I think she's probably feeling a lot of pressure from Germany. If you've looked at the German, especially the manufacturing PMIs just earlier this week, they're horrendous. And you know, when you have when Germany is the growth engine, if you will, of the European Central or the Eurozone, if you will, and you know, they have plenty of seats in the ECB, you know, Board of Governors. She's probably feeling a lot of pressure from Germany specifically, and so yeah, I think she wants this cycle to be over. I think most everybody does, but the problem that we're all facing, and I think that the best case, or I shouldn't say the best case, the best example of a stagflationary environment is what's happening in the UK with persistently high inflation, but now you have growth that may actually go negative, and you know, then they've got a real big problem. And I think Europe's kind of facing that as well.
Sure. Yeah, and Europe, I think we're hitting up against some energy-derived base effects over the next few months, where I think people may be declaring victory over inflation, and the battle may not be over. But we saw, especially gas, you know, really rise Q3, Q4 of last year, and so they'll be measuring inflation against that. I'm not sure that's going to be kind of, you know, the battle is won type of environment for Europe.
You know, I want to defer to like Tracy and Albert as well, but Tracy, you follow a lot of these commodities. I was really carefully watching cotton over the course of the last couple of weeks. It had been basing since, like, I want to say like the fall of last year of 2022. And it just broke out of a base, like literally this week. And when you see, you know, these commodities percolate, that's going to make life a little tough, especially when you have, you know, certain financial conditions are looser than they should be, with equities where they're at, with the trickle down effect. You got people feeling a little wealthier. Their houses or their multiple homes haven't really lost a lot in value yet. You know, and then you throw that type of spending on top of commodities staying very perky. Yeah, I think this last leg of getting inflation from 3 to 2% is like running the 22nd to 26th mile of a marathon, and that's where they're at. It's not going to be the easiest part.
Yeah, I mean, what we really should look at is the core CPI. I mean, that's still raging hot. You know, all the points that you made were absolutely correct. I mean, we've discussed this for many months now, Tony, and with Tracy, that Europe is just a zombie economy. And the moment they start ticking up in any which way, inflation starts to rage again. And energy inflation is gaining steam, not only there, but also in the United States. And, you know, we have a problem. I mean, the cheerleaders of, you know, we've solved inflation because they have a three handle is a little bit silly and way premature, in my opinion.
Very. Yeah, let's circle back, Blake, for just a minute to talk about BOJ. I know we're going to talk about a lot of the commodity stuff in the next section with Tracy, but let's circle back to BOJ. There are some stories out today on Thursday about the BOJ tweaking yield curve control to cap it by 0.5%. So that is a pretty massive change. And I know they just changed their BOJ chair about 3-4 months ago. So he didn't want to make any changes right away. But it sounds like he's really starting to talk about some incremental changes. This is a pretty small change, but it's actually a pretty big change. Can you talk to us about that a little bit?
Well, I think it is a big change because it would be a step in the direction that the markets don't want to see. The last time Bank of Japan tried to move off the zero bound was just pre-GFC, the financial crisis in 2008. Here they are again, trying to move off the zero bound, first starting with yield curve control tweaks. Now, the BOJ, we have a new governor, BOJ Ueda, which is really interesting, is he had been so in his academic papers that he's written over the last couple of decades, how critical he's been of the BOJ and where they're at. He jumps into the BOJ driver's seat and he ends up being just pretty much the same as Kuroda. Probably from a political standpoint, not one to rock the boat too much. However, he also pulled a very similar move to Kuroda this last week, where they leaked out from official sources to Reuters, probably every article from every journalist, from Vogue to who knows what, The Economist, saying that they weren't going to tweak yield curve control. We saw a move in the yen move lower. So people like myself that were pre-positioned waiting for this yield curve control leak, we got stopped out. I took some losses last week because of it. And then here goes today from the Nikkei, paper suggesting that tonight or tomorrow morning in Japan, they're actually going to make the tweak and move the band so they can allow it to trade up to 0.5%. Now, that in itself is that tweak of that yield curve control, or allowing it to move, is basically step one of probably many steps of trying to normalize their monetary policy. But if you think about that, that's the last central bank that we have that really is keeping ultra loose policy, and that's I think the takeaway that the markets need to start looking at, especially equity markets globally. So,
right, very hard for them to continue importing inflation, but also very hard for them to fight against demographics in terms of the kind of productivity value add in their economy. So they're in a really rough place. So can we look at a number of currencies? I have a chart up now on several currencies. And I want to just kind of walk through some things with you as we look at where we are. First, on the top in blue, we've got Japanese yen, which we've seen real depreciation since 2022. Can we talk about, within the context of the dollar, if this BOJ policy really does go through, do we expect kind of marginal appreciation in JPY, or do you think it'll really come back down to, say, 120 or something like that?
That's a great question. I think over time, depending on how aggressive the BOJ has to be, I think 120 would be probably a realistic expectation from a technical point of view, because you'd be looking at like an equal leg move from the highs down to the lows that we put in January of this year. So that would probably take us in the range of 120, and it's not going to happen overnight. But it's baby steps for the Bank of Japan, and I think that the first real key is going to be kind of what I saw as channel support, which it would be around the 136 level. We start trading below 136, 135. I think a lot of longer term yen shorts might be looking to exit those positions at that point. So,
okay. And then looking at CNY, China's economy is in a real tough spot, and we've seen some devaluation there. What's your expectation with CNY CNH? Do you expect to see continued devaluation there, or are we kind of in that zone where the monetary guys in China are comfortable?
Well, I don't think they're comfortable at all, and that's a great question, and it's a really as you pointed out, it's a really complex situation that China's dealing with. They tried this. They thought their opening would be great. The issue that China has, and if you've watched China over the last 20 to 30 years, trying to shift their economy to a consumer-based economy hasn't. I mean, they've made a lot of billionaires and millionaires, as you could imagine, but still a majority of their country is not in that situation yet. Yes, I get to eat 5 bowls of rice today versus 10 years ago I only had 3 bowls of rice. Maybe that's the difference for a lot of their population. But the fact of the matter is they're really trying to rely on domestic demand, and they just said it in the Politburo meetings this week that they are struggling with that particular issue. So they have a few levers that they can pull: stimulus levers, reserve ratio requirements. They can try to spur domestic loan demand, but the real estate markets are a little iffy at best, because a lot of Chinese, they have multiple properties, right, that they own. So trying to get them to leverage up and borrow a little bit more, it's a hard or a tough ask for the Chinese people. So, China's got few levers left, and one of them happens to be with the CNH and the CNY, trying to get the yuan or the renminbi lower to spur more, demand from Europe, from the US, make their goods cheaper. But it's hard for the PBOC to pull that lever without looking too obvious, right? Because we know they have the lever, we know they can pull the lever, but we know politically it's not, it'll be frowned upon. So I eventually expect the US dollar CNH to break above 730 and maybe even go towards 750. And that would be signaling to us as investors in capital markets globally that China's really feeling the heat. So, can the US dollar CNH continue to dip maybe down towards the 200-day moving average around 7? Sure. Do I think it's probably a buy down there? I don't trade it, but I think people that do are probably looking at that level as an attractive level to be on the long side.
Okay, yeah. And I think one of the key things that I look at when I look especially at Northeast Asian currencies is you have this movement with the BOJ, which will likely appreciate JPY. You have the Korean won that's appreciating. China's domestic economy is a mess, and they really need to goose exports so they can, use that industry to further develop domestically. And so, given all the troubles they have at home, that might be an easy decision for them to make, to devalue just a bit to goose some exports, especially as more industries move off of the Chinese mainland for a lot of kind of political reasons. So, in terms of moving industries, I want to also talk about the Mexican peso. We had a viewer question about the Mexican peso, and we've seen the Mexican peso appreciate pretty nicely against US dollar over the last, say, 9 months or something. Can you help us talk through and understand why the Mexican peso is moving in that direction?
Yeah, you bet. And this has been the darling of the FX market. And by the way, going back to China, I just want to say I'm not the best China expert. I have some European members in the Forex analytics team that trade the US dollar CNY and CNH quite aggressively. So they're better. I kind of take from them, what I can. But as far as the Mexican peso, it is something that I trade quite actively and aggressively at that. It's been the darling of the FX market as a carry trade. When you can carry the Banxico's higher rates over anything else, especially, the euro, the yen, the Mexican MXN, JPY, the euro, MXN, dollar, Mexican peso. The Mexican peso has been the star. And the reason why is because the rates are extremely high, and FX institutions will park their money in pesos and they'll sell other currencies. And that's great in a market where stocks are rising. We see that volatility is low. Those, we call them carry trades. That is the carry trade. It's kind of like the yen of the mid 2004 to 2005 era. The Mexican peso is in that situation. The risk at this point is that we're starting to see other LATAM currencies like I always forget the central bank, the Chilean central bank, BCCH, is that what it is? Anyway, they're about ready to embark on a rate cut campaign. Now, Chile is not Mexico, but it is a LATAM currency, and you're starting to see some of these emerging market currencies. Banxico stop raising rates as well. Will they start cutting rates? If they do that, the margin that you're going to get on that carry is a little bit less. Then if you start to see equity markets really come under pressure, Like, let's say the S&P trades from 40, it's trading around 4,500, 4,550 right now. We trade down to 4,400 or 4,300. You're going to see the air come out of the Mexican peso, and you're going to start to see the dollar outperform, the yen outperform as the BOJ adjusts their policies. Even the Euro Mexican peso is probably going to recover after having, such a big slide. So I'd be careful with the Mexican peso, as it trades below 17. I think if it trades back above 17, 1705, especially 1750, we're probably looking at a squeeze well over 18 again. So,
okay, great. Yeah, thanks for that. We don't talk about Mexico a lot, so this is really interesting.
Yeah,
I like the Mexican peso simply because the trade has increased tremendously between Mexico and the United States.
I cannot disagree with that, and I think Mexico is the U.S. is China, and I specifically when I played golf, a couple rounds of golf with a gentleman that has a chip company that he's actually migrated his employees from China to Mexico over the last 3-4 years because of labor costs. Right. And so I am actually a Mexican peso bull. If people that know me know that I believe the dollar Mexican peso is eventually going to be trading in the lower teens over the course of the next couple of years. But right now, the specific risk is that we trade back to 18 before 15. How about that? Maybe that makes sense.
Yeah, I'll leave the Forex stuff in the levels
to
you.
And that was the exact question I was going to ask. So you say, does it have to do with trade with the United States, as we're seeing a lot of manufacturing, which was big in, say, the 80s in Mexico, now returning to Mexico with trade to the United States, or say, U.S. companies moving their manufacturing to Mexico rather than China per se.
Yeah, and Tracy, that's like I gave you that one example. It's anecdotal evidence, right? It's not like something I hang my hat on, but I think that is a trend that we will see in the years ahead, is as China's labor force shrinks and it costs more to produce in China, the rest of the world is going to search for alternatives. Most of them, like a lot of Europe's going to go to India. We'll go to India, but Mexico is our next door neighbor and labor is still cheap there. So, we will find alternatives, and I think the rest of the world will away from China. That's one of the issues that Tony, you brought up about China. They got issues. You try to change your whole demographic and, of your entire ginormous country, there will be repercussions, and this is one of them, I think.
Yep. And it'll happen, it'll start slowly, and then people will realize it, and it'll hit hard pretty quickly at some point. So I think looking at CNY, CNH right now is really important, because I think we're in the early days of something larger happening over the next few years.
Great news, traders and investors. CI Markets has expanded its coverage to include stocks from the S&P 500, Nasdaq, Nikkei, FTSE 100, and the top 50 ETFs. With more than 1,500 forecasted assets, our AI-powered platform provides highly accurate forecasts. Join our community of successful investors who rely on CI Markets insights to make informed decisions. Subscribe now for as low as $20 per month and unlock the power of comprehensive forecasting. To learn more or book a demo, visit completeintel.com/markets.
So Tracy, let's talk about resources for a minute. I know that's kind of where you live every day. So we've seen strength in commodities over the last three months. I've got a chart up on copper, WTI, and Natgas up on the screen right now. So why are we seeing a rally in commodities now? Is this really on the back of a weaker dollar, or is there something more to it?
Well, I think we need to look at each one of these separately.
Good.
To be honest, just for example, Blake brought up the cotton issue, and why is cotton starting to rally off the lows now? And that's kind of a China stimulus story right now, right? Because they have a lot of manufacturing, they make a lot of cotton t-shirts, et cetera, et cetera. So I think it's really hard to lump all of the commodities together. So I would like to, look at, I think we should look at oil, or the energy sector in particular,
Yep.
separately from, say, the metal sector,
Right.
separately from, say, the softs, right? And so I think if you're looking at the energy sector in particular, you are looking at a weaker dollar. That always helps. And suddenly signs of life from China, meaning people are starting to believe China's stimulus matters, whether it's come true or not. We really haven't seen them say a whole lot until the last couple of weeks. I mean, if you can even look at the Hang Seng on this, and which is down 5% on the year, and over the last weeks, surging right away, right? Goldman just put out a note on Wednesday that said funds are piling back into China at the fastest pace in 9 months over the last week, which is huge based on what they have said over the last week and a half. And whether you believe them or not, the markets believe them at this point.
Mm-hmm.
And then, as far as energy is concerned, we still have that supply demand issue. We have Russian exports down. We have voluntary cuts filtering into global markets right now. And we are also seeing recession fears sort of seeming to subside a bit, because markets are starting to believe in this kind of soft landing, or at least the commodities markets are, right? The equities markets, that's a whole nother story. And then if you look at the metals, again, I think, if you look at the metals, this is again a China story. Suddenly everybody's believing China's stimulus at this point. Again, I don't know what exactly changed and what exactly changed the market's mind, but I think it was, helping a little bit of the property sector, which is definitely not enough in my opinion, as well as the tech sector. The couple of announcements that they put out over the last 2 weeks. And so, I think that's really what we're looking at right now. And again, a lot of it is the China story.
Okay. So we've got Europe dead. We've got China kind of dead with some commitments to them to maybe get stimulus. And we've got the US slowing down into the end of the year.
Well, if we're talking about the energy sector in particular with the United States, we have implied demand over the last several weeks has risen from 19 million barrels a day to 21.7 million barrels a day, which is huge. That's over 2019 levels. And so we're not really seeing, and in implied demand, you can take in different ways, but that is what, product supplied is implied demand. That's what everybody takes it to be. So, so we're not really seeing demand being lowered in the United States. We are also looking at place in August where we're going to see a lot of exports to China, because Russian oil is getting to be more expensive right now, right? We're above that price cap. And so we're seeing China has put a lot of orders in for the United States for WTI Midland for August delivery. So, we will see drains here in the United States as far as inventories are concerned. And we still haven't seen China overall. I mean, over this whole period, that everybody's thinking China is imploding, which they may or may not be, they've been buying oil hand over fist. And perhaps, yes, that's a lot of it's going into storage. They can build storage out. But a lot of it, if you look at the refinery runs, are also huge. So,
Tracy, I'm so glad you didn't say China's stocking up to go to war, because I'm so tired of that.
I don't think China likes cheap oil. Let's be real, right? Yep. So they can get a huge discount from Russia, right? Yeah. And get this price cap. And so, at the time it was $20 below the price cap. Of course, who's not going to stock up? India stocked up. Everybody's going to stock up at that point, right? You're going to buy hand over fist. So actually the best thing that the United States the best thing the West could hope for is that Russian oil is trading over that price cap. Because you know why? that doesn't make it as desirable anymore. Nobody's going
Right.
to buy as much anymore.
Right.
You know, I think it's short-sighted thinking to say, oh my God, they're trading, you know, they're trading over the price cap. Well, great. That means it's not as desirable anymore. Why would I deal with the hassle of buying with them if it's only a few dollar discount?
Right. Do you mind if I interject and ask a question here?
Absolutely, yes.
Okay, so you know, and Tracy, this is something I think about quite a bit. Just because we're having this discussion about crude oil and inflation. Going back to the inflation question, you know, it's interesting. You watch crude oil rally, and you know, and everybody cheers like, oh, you know, things must be getting better. But you know, there's always that inflection point, and I'm not sure where it is in crude or RBOB or whatever you're looking at. But at what point do these higher energy costs really start to translate to, oh my God, that's going to bite the consumer here in US, globally, wherever you're talking about, and crude going higher is not a good thing. You know, there is that inflection point. I don't know where it's at. I don't know if it's at 80, 85, at 100. Do you have any thoughts on that?
You know, I think it really depends on the state of the economy and where we're at. You know, I think at $70, you know, we're still in that $70 to $80 range. And I think
Goldilocks, right? Goldilocks.
That's comfortable. It's very comfortable, right? You're not seeing $5 oil, gasoline prices at the pump. You're not saying, you know, that's a very comfortable position for oil to be in at this juncture. If we start to see oil prices spike higher than that, of course, that's going to matter. And of course, this is all going to filter into, you know, energy runs the economy. You can't do anything without energy. You can't run a business because you have to keep the lights on. You can't grow food because you need energy to grow food, right? So energy runs the economy. So at some point, yes, it's going to matter. It's going to filter in. It's going to make, it's going to make prices higher. And I don't think that, you know, I don't think we're going to see 2% inflation anytime soon. In fact, even Powell doesn't think we're going to see 2% inflation anytime soon. He said yesterday we you know, we're not going to see this to 2025. I tend to think that that's ambitious goal, because I think that no matter what we do at this point, if we're looking at energy transition and we're looking at all of these policies we want to put forward, we're still lacking a lot of these materials. We're still lacking a lot of energy for this. And so, this is going to be a huge problem that central banks just cannot counteract, no matter, you know, they may try. And actually, you know, Peter Bookfire brought up a really good point yesterday when I was interviewing him. He said, it's easy to bring inflation down quickly with high rates. It's harder to keep it down.
Mm-hmm.
Tony, who told you that the more they rally this market, the more inflation is going to be a problem?
You did, Albert. You said it a long time ago.
I mean,
you said it.
Why people think that, you know, as they rally this market in silly stratospheric levels, that they didn't think that commodities and oil and wheat and cotton and every other thing is not going to run? Of course it is. Their problem is they're running out of room now for rate hikes. Right. So what are they going to, the only other option that I can see that they're going to use is the US dollar. That's the only thing they can do, is take the dollar back up to like the 108, 109 area, you know, just before you start breaking Europe and the rest of the world, to try to tame inflation, because they don't want to see, you know, 6-7% CPI prints going into an election year. That's just ridiculous.
Isn't it crazy, Albert, how the dollar can be weaponized? And it really can be. I believe.
Of course it's going to be weaponized. It's the reserve currency, and Janet Yellen controls the policy. She's going to do what she needs to do whenever she wants to do it. Unfortunately, that's just the reality.
Yeah,
but it's just the reality of the situation. And as I was saying, rate hike runway is pretty much ending. So the dollar is the only thing that they're going to be able to use.
Wait, so your thesis is that U.S. rates will top out at 6%, and that's going to crush China. Is that right?
Oh yeah, China was never prepared for 6% rates.
Okay,
absolutely.
And again, tell us why. I want to make sure everyone understands.
Well, it's just the debt. It's just the debt level, the amount of debt that they had, and the way they funded their debt. They just weren't. No one was. I don't think anybody on earth was thinking that 6% Fed fund rate was coming. But you know, here we are at 550 almost. You know, with probably another 2 hikes to go.
So we hit 6%. Now China's been evergreening debt since 2009, right? They have all that debt from 20 years ago. They've continued to evergreen because they haven't been able to pay it off, and so on and so forth, right? And so Fed funds rate hit 6%, and the Chinese are practically begging the US not to raise anymore. Is that fair to say?
Oh, absolutely. And you know, it's funny because, you know, Yellen was just over there, and then coincidentally the dollar tanked underneath 100, you know, as soon as she left for like a day or two.
Total coincidence, Albert.
Total coincidence, you know, total coincidence.
I tweeted that out.
Total coincidence.
I absolutely
her getting psychedelics was total coincidence as well.
Yeah.
that was the best part of the whole. Explains so much.
But I agree with Tracy wholeheartedly. I think 65 is a floor for oil, and I think probably 85 is probably a top for oil. It's a comfortable zone that they're willing to deal in, you know, for the next whatever year or so.
Okay, great. Let's move on to earnings, Albert. I just want to cover a little bit on earnings here. So, what are your thoughts on Q2 earnings? So far, we've seen S&P 500 companies report the slowest growth in margins since Q4 of 2020. So over the last probably year and a half, we've talked about the pricing power that companies have had since about Q2 22, where they were able to continue to expand their margins and raise prices on customers, and customers would just accept it. That seems to have come to an end, at least a bit. So is that what's driving this margin compression? I've got a chart from FactSet on the screen showing the margins of companies coming down to right around 11%.
It's not just that. I mean, we talked about this maybe like 6 months ago, saying that, you know, this is probably going to end up happening where margins are going to start ticking down second half of the year. And that's exactly what we're seeing. The issue is labor rates are still advancing. Their fake CPI is, you know, giving a little bit more, still a little bit of tailwind for earnings, but that's slowing down too. So they don't have that inflationary tailwind to jump up prices as demand is starting to tick down. Consumers at this moment are, you know, they're a little bit more price sensitive. You know, they don't really need, you know, a Rolex watch or a secondary home or a third boat and whatnot. So, you know, as that money is starting to dry up, you know, margins are starting to dry up too. And I think that it's going to be a bigger problem for Q4. However, if I'm right and inflation is ticking back up, there might be a little bit of a you know, earnings tailwind into 2024, mid 2024 again.
So Albert, since you and I just met for the very first time today, it sounds like you're obviously following earnings pretty closely. How do you feel about like the Richemont Group last week, and then like Louis Vuitton this week? I mean, what does that tell you about the high end stuff, right? And the high end global consumer?
You know, the high end global consumer, I've always watched to see when they start retracting spending is when I start to get nervous. Whenever the big homes in Naples, Florida stop selling, and Louis Vuitton starts getting worried about their demand, that's always problematic. Now, as you know, I personally love Brunello Cucinelli. That's my brand. I've watched them for years, seen their stock price go from 38 to 80, and as recently this last couple of weeks, I've been noticing their ticker like trending downwards, and I looked at their sales, and their stores are not getting as many people in. Their online stuff is going more to outlet than it is you know, into the stores and out to like the top consumers. So yeah, I think the top consumers are about to pause. If not paused already, they're about to start pausing in Q4.
Yeah, you know, the Richemont Group, I think that last week they were down 10% in European trade. And, you know, Tony, that goes back to your point about China, and they saw the Chinese high-end consumer that they're the problem. All right.
Yeah, they say that, but that's more than just that. I mean, the Chinese high-end consumer is one component of it, probably, you know, a real big one, but, you know, the Middle East is probably showing the same sure. little drawbacks. North America and Europe is obviously going to have falling sales in the luxury market. So, you know, they can blame China, but it's a lot bigger than that.
Yeah. All right. Cool.
So I want to talk for a second about tech, Albert, because I know you love to beat on AI. Even though I run an AI company, I don't take it personally. So on tech, I thought it was really interesting that Microsoft's growth for Azure hit 25%, but AI was only about 1.5% of that growth. So I think some real questions have come. People have really started to think about AI. Like, if Microsoft can't get money out of AI because they're effectively the owner of OpenAI, right? So if they can't make money out of AI, who can? So, we've seen for the past 2 earnings calls, AI is mentioned dozens of times on so many earnings calls, right? So when do you think we'll start to see that? Or do you think AI is just a feature in larger products that just help people kind of retain and marginally grow?
Yeah, I think that's correct. I think that's just a feature in the larger products. The only AI that I would be excited about is whatever comes out of Apple.
From what I complete intelligence, of course.
Of course, complete intelligence. Yes. $1 trillion moneymaker right here.
Right.
But as a stock that's actually traded, Apple would be my number one for AI. From what I hear, they have a working AI internally that's just like off the chain. But Apple's really smart. They wait years to perfect something before they start releasing things. So I just think that AI is a little bit too premature, and I don't really like the marketing talk by some people just throwing AI around like as if it's some godlike feature on an app. It's not. So I think we got a ways to go for that.
Yeah, I mean, look, my view is large language models like ChatGPT and all the stuff that Microsoft's starting to do is really just a synthesized search engine. It makes your search a lot smarter. That's all it does, right? It'll take out some low-level analyst jobs to write some papers for you. It'll make your searches better, that sort of thing. But we're not to the point where those LLMs are real money makers right now. They make those applications more useful. Does that make sense?
Anecdotally, wasn't there just an article out that's saying AI is getting dumber? Right.
Well, because it's garbage in, garbage out. I think you're talking about where a ChatGPT was answering 98% of math problems correctly, and then just recently it dropped down to 2%. So
it answered 2% correctly?
Yeah, 2% correctly. It's garbage in, garbage out.
I'm going to look that up.
Yeah, I
look it up. He posted it. I read it before he posted it. It's true.
Because I don't need AI to do those problems. I can get 98%.
Well, that's the thing, Tony. It's like, and I always tell people, whether it's technological or political, social, things happen incrementally. There's never some kind of like jackpot, trade or technology that comes out that changes the world like we've never seen before. It's just things happen in stages.
Yeah, but to OpenAI's credit, AI, I think, was a really far off imaginary word to a lot of people until ChatGPT was brought to market. And then I think people went, oh my gosh, this really changes things. And I think it did. I think it's the biggest change to search that we've seen in 20 years.
I
and it's made it a lot easier. What's that?
You just have to make sure it's correct, right? Because you hear these stories, some lawyer used this for a brief and they brought in a whole bunch of
legal trouble. Yeah,
didn't really happen.
Yeah, it's definitely like an assistant, and you have to go back and double check the work. I look at AI as like kind of the Google Glass of today.
Yes.
Right. I mean, I'm sure at some point we'll all be wearing weird things on our heads. Whether it's.
I hope not.
Whatever. Well, just wake me up when Ex Machina actually happens, and then I'm going to go run for the hills.
Right, exactly. Just circling back to earnings for a minute, Albert. Are you, as we finish out this earnings season, are you looking for? Are we recapturing earnings momentum, say later this quarter or into the next quarter, or do you see things continuing to gradually deteriorate?
I think we're going to gradually deteriorate into the end of the year, with probably earnings starting to tick back up Q1, Q2 of next year in the run up to the election. So I obviously tech earnings, it's the fabulous five of like Microsoft, Google, Apple, Nvidia, so on and so forth. Those are the ones driving the market. So that's the ones I would be watching.
Very good, guys. Thank you so much for your time. This has been excellent. Blake, thanks for joining us for the first time. Albert, Tracy, thank you for your time as always.
Thanks,
Have a
Tony.
great afternoon, guys, and have a great week ahead. Thank you.
Thank you.
Thank you.
Say,
Thank you.
thank you all.